question and then we will take a 5 minutes break. Now, this is a very good question. I like this question because it's not a past paper question. It's basically a question which is related to the article which examiner has highlighted in its article, right? What it says it has given you 2000 profit of 2009 and 2010. Operating profit of 2009 is given, 2010 is given, interest expense, profit before tax, tax and profit after tax figure, everything is given, right? Now, let's proceed. What it says, the allowance for doubtful debt was 3 million at 1st January 2009, 250,000 at 31st December 2009, 350,000 for 31st December 2010, right? So there is a discussion of allowance. Allowance will be adjusted in P&L and balance sheet both. Now, then it says research and development cost around 500,000 were incurred during each of the year 2009 and 2010. I'm reading this part. Research and development cost of 500,000 were incurred in each of the year 2009 and 2010 on project Z, right? 500,000 expense. These costs were expensed in the income statement as they did not meet the requirement of financial reporting standards for the capitalization. Project Z is not completed yet, right? Now, think for a while what will be its impact on balance sheet and profit and loss account. Just think for a while what we will do with project Z in balance sheet and profit and loss account. Yes, what we will do, since this is a research and development work, so we will add this. And do we need to amortize this? Definitely not, because this project has not been started. When this project will start, we can charge its amortization, but till now, since this project has not been started, we cannot charge its amortization, right? Now let's move to the next part. Next it says at the end of 2008, the company had completed another research and development project, Project X. Total expenditure on this project had been 1.5 million, none of which has been capitalized in the financial statement. So there is another project, Project X, and this has also not been included in the balance sheet in the financial statement because sorry, total expenditure in this one, none of this had been capitalized, right? So this project also has not been capitalized because of certain reasons, probably. The product developed by Product X went on sale on 1st January 2009, and the product was a great success. Now, when it started in 2009, January 2009, and the project was a great success. The product life cycle was only 2 years, so no further sales of this product are expected after 31st December 2010. So this is the end here. This is the end of the story here, and 1.5 million has been included in this project, right? The company at the end of 2008, this till the end of 2008, this has already been charged, right? Now, the company incurred non-cash expenses of 1.5 million. Capital employed is given, pre-tax cost is given, the company's capital structure is given. There was no provision for deferred tax. You are required to calculate economic value added, right? How we can calculate economic value added? Let's start. All right. We will start from what? We will start from profit after tax of 2009 and 2010. Be careful because in this case there is a problem. 2009 is given 2000. This is 2010 and this is 2009. So this part we are making first, and this part we are making in the second column. Try to concentrate here. Now we will start from profit after tax. Profit after tax is 3450 in 2009 and 4125 in 2010, right? Now let's move to the first part. What is first part says? The allowance for doubtful debt was 300,000 at 1st January 2009, 250,000 at 31st December. Sorry, the allowance for doubtful debt was 3 million on 1st January 2009, which is the opening balance of 9, 250,000 at 31st December 2009, and 350,000 at 31st December 2010. Now let's make it in the profit statement here. 2009, 1st January 2009, 1st January 2009, this was 2,50,000. Then on 31st December 2009, it was around, sorry, I made a mistake. It's 300,000. Then it was 250,000 and 31st December 2010 was around 3,50,000, right? This is basically the situation of the allowance for doubtful debt, which is the accumulated figure. Now, in 2009, by the end of 2009, there was a decrease in um, provisions, right? Whenever there is a decrease in provision, we say that this is basically an income, and we add that figure in our profit and loss account, right? I'm repeating, whenever there is a decrease in provisions, we consider that as an income and we add that figure in our general profit and loss account, right? But since provisions are not allowed, so we cannot add that figure, so we have to adjust that figure, and for adjusting that figure, we have to deduct that figure. So decrease in provision will be added here by 50. Sorry, will be deducted here by 50 because there is an increase in decrease in expense. Income has to be deducted, that has to be adjusted. And in this phase, there is an increase in expense of 100 million. 100 million means we have to add this figure. So we'll add 100,000 here, right? Now, because this is expense now, the expense has already been deducted. So profit is already understated. So you have to add that figure in order to restate the profit, right? Then it says research and development cost 500,000 were incurred during the years 2009 and 2010 on project C. These costs were expensed in the income statement as they do not meet the requirement of the financial reporting standard for capitalization. Capital Z is not completed yet. So we have to add research and development work because we cannot deduct research and development. We will add these figures, and when it will get completed, we will capitalize that and we will further amortize that. But since that has not been completed, we are not going to amortize it. So 500 will be added here. This will be the adjustment of 2009 P&L, and 500 will also be added here because this will be the adjustment in 2010. I mean, in 2010, 500 R&D has already been deducted in 9 and 10 both, so we have to add it. Amortization will not be charged as the project has not been completed yet. Now, this is actually related to project Z, right? Then there is a research and development on project X, right? There is another R&D on project X. Now, project X, it says that in project X, um, expense has been made at the end of 2008. That means that has already been charged in the previous profit and loss account, in the previous year's profit and loss account, right? And this project has already been started on 1st January 2009. That means 1st January 2009, it has already been started. Since this project has been started, now we can charge its amortization, right? So amortization has not been included in this P&L. So we have to charge amortization. We are not going to add back this figure because this figure has been charged in the previous years. So since has been charged in the previous years, it has to be adjusted in the retained earning part, not the profit and loss account of this year. So 750 depreciation amortization will be charged in 2009, and 750 amortization will be charged in 2010, right? Then it says that companies incur non-cash expense of 15,000 in both year. So plus non-cash expense of 15,000 in both year, we will add here, right? And what else is remaining? Capital employed, we don't need that. Pre-tax, nothing. Now we need to add one more figure here, which is the interest expense net of tax. Interest expense net of tax. Now interest expense is 900 in 2009. 900 times interest, what is the tax rate? 25%. So we'll add 75% of 900. 75% into 900, that makes 675. 8 minute. 900 is of 2009 na? Alright, so we are doing it wrong. 675 will be added here. Right? And then it's 1000 times 75%. Right, now just let's calculate these figures. Let's see what's here. 3450 minus 50 plus 500 minus 750 plus 15 plus 675. That makes 3840. Right? Now 4125 plus 100 plus 500 minus 750 plus 15 plus 750. 4740. Right? So this is the economic profit. This is question number 2, right? Now, Let's start with the capital part. This is 2009 and 2010, 2009, 2010. All right. We'll start from the opening capital employed. Opening capital employed is 2008 capital employed. Capital employed is, all right, capital is this part. Capital employed, our as per statement was 33,500 on 1st January 2009. 33,500. This is the opening capital. And then 37,000 in 2010, at the 1st January of 2010, right? Now let's see what's given here. The first statement says that the allowance for doubtful debt was 300,000 at 1st January 2009 and 250,000 at 31st December 2009. This 33,500 is actually, it is related to 2009, but practically this is basically the closing capital of 8, or you can say opening capital of 9. Opening capital means 300,000 at 1st January 2009. This part. 1st January 2009 accumulated doubtful debt was around 300,000. So we'll just add 300 here and 250 here. Right, this is allowance for doubtful debt, right? Now, research and development cost of 500,000 were incurred in each of the 2009 and 2010 for Project Z. Project Z has not been completed yet, so we cannot capitalize it. Remember my words, we are not going to capitalize it. But so there will be no adjustment in 2009 because it started in 2009. So 2009 profit has been adjusted by using this 500 here, right? But 2010 profit, this is the original capital employed, right? And in this original capital employed, it includes retained earning of 2009, right? And in 2009, original accounting treatment, in original accounting treatment, 500,000 has already been deducted because that is necessary for accounting treatment. But what we are saying no, you cannot deduct that. So if you want to adjust prior period 500,000 adjustment, you cannot do it in profit and loss account. So this 500,000, which we adjusted here, we need to sorry, we since 500,000 which we have already adjusted here, need adjustment in 37,000 as well because this is the original capital employed. So 500,000 will be adjusted here as a prior period adjustment, right? In the retained earning part. All right. What will happen to Project X? Project X has already been completed in 2008, right? So all expenditure has been charged in 2008. Now, and then we need an amortization. Now, again, I'm repeating, this capital actually belongs to 31st December 2000 and 31st December 2008, right? So that means what, till 31st December 2008, 1,500,000 pounds development expenditure has been charged. So we have to adjust that, and since this already project has already been has already taken off, therefore amortization is also important. Amortization is necessary. So what we will do is we will add this 1500,000 whole figure here. Why we added 1500? Uh, we deducted amortization here. Yes, we deducted amortization, but the point is this 1500,000 is actually reflecting this part, this 2008 part, this part, right? What depreciation which we have charged in 2009 will be reflected in 2010, right? So opening in the opening of 2009, this capital employed, this 1500 capital employed, we will adjust this 1500 capital employed, and then amortization which we have charged in 2009 will be deducted from this figure, and the opening balance will be around 750 in 2010, and in 2011 there will be no capital employed. So that makes sense. I mean, we have 50, we have capitalized 1500, then we charged, deducted 750 as an amortization. We included 750 here, and then we will again deduct 750, and there will be no project X value in 2011, right? Now, then it says that now then it says that the company incurred a non-cash expenses of 15,000 in both year. So non-cash expenses, again this is a P&L item. This is not a balance sheet item. This is a profit and loss item, but non-cash expense. This is a profit and loss item, but since we have to adjust profit of previous years, we have to adjust it in retained earning. So there will be no adjustment in 2009, but in 2010 we will adjust this figure, which is equals to 15,000. We will adjust 15,000. We will in fact add 15,000. Why? Because this 15,000 actually reflect the prior year adjustment, and that means the retained earning part, right? What else do we need to adjust? We are done with 4 point. 5th point is capital, 6th point is VAC, and 7th point is, that's fine. So that's the end of the story. This will be 33,500 plus 300 and then plus 1,500. That is equals to 35,300, right? And in the second year, this will be 37,000 plus 250 plus 500 plus 750 plus 15. That makes 38515, right? Now, all what I want you guys to do is try to, I mean, profit figure is already given 3840, 4740. We have calculated the adjusted capital employed. All what you need to do is to calculate the value of WACC and then calculate economic value added. Let me show you one part, and I hope you can do the second part at your own. Economic profit for 2009 is what? That is around 3840. 3840. And then 35,300. 35,300 multiplied by the WACC. WACC is mm, is there any detail relating to cost of equity? The pre-tax cost of debt was 5%, cost of equity was 12% in 9 and 14% in 10. So 12% in 2009 multiplied by equity is 60% plus cost of debt is 5% multiplied by 40% का 75% tax, right? So let's do this. 5 into zero point 0.4 into 0.75, that makes 1.5. 1.5 12 multiplied by zero point 0.6 plus 1.5, that makes 8.7%. So 35,300 times 0.0875, that makes 3089 minus 3840, that makes 751. This is basically economic value added, right? So you can do 2010 at your own, right?